Brent was down almost 3%. And it happened on the same day OPEC Plus said, no change. That mismatch is the story, not the headline, the price. By the end, you'll know why oil fell anyway. And you'll have 3 concrete signals to track. Here's what happened, with timestamps. On February 1st, Reuters reported OPEC Plus agreed to keep March output unchanged. OPEC also posted a statement that 8 participants reaffirmed the pause. At the same time, Reuters reported Brent fell about 2.8% to 67.39. WTI fell about 2.9% to 63.32. So the market saw supportive supply. Then it sold. Now, pick one real-world anchor. Picture a mid-size airline fuel manager. They buy jet fuel week to week. They care about 2 things, the all-in price and the volatility. When Brent drops 3% in a day, they smile. But what they really need to know is why. Because if it's a fading risk premium, it can bounce back fast. If it's a demand problem, it can keep sliding. And their next fuel order sits inside that difference. Start with the clean mechanism. Oil is not one market. It's 2 markets layered on top of each other. Layer 1 is fundamentals, supply, demand, and inventories. That's the slow engine. Layer 2 is risk premium, geopolitics, shipping risk, and disruption probability. That's the fast engine. An OPEC Plus freeze mostly speaks to the slow engine. It says, we are not adding barrels next month. In a vacuum, that supports prices. But the fast engine can dominate a day's tape. If the market reprices the chance of disruption lower, premium evaporates. That can push prices down, even if supply policy looks tight. Reuters framed the drop around focus on Iran talks. That's the key receipt. It's not that output suddenly surged. It's that the market decided the worst-case path was less likely. Here's the line that matters. In the Reuters report, the move is tied to talk headlines and de-escalation focus. That is a premium story, not a barrel story. Now translated into market plumbing, a risk premium is basically insurance priced into the barrel. When traders think shipping or sanctions risk is lower, they pay less for insurance, so they bid less for prompt crude. That shows up first in time spreads, prompt month versus a few months out. If the drop is mostly premium compression, spreads often flatten. Sometimes they flip toward contango. If the drop is true oversupply, spreads flatten too. The difference is what happens next with inventories and physical differentials. That's why this is a clean, what breaks first setup, because the first break tells you which engine is driving. Now, the cross-asset snapshot. You need at least 3 buckets. Bucket 1 is inflation pricing. Lower oil can pull down near-term inflation expectations. That can ease pressure on break-evens. It can also soften the narrative that central banks must stay tight. Bucket 2 is FX. Energy exporters often feel it. Think Norway, Canada, and some Middle East pegs through fiscal math. If crude keeps sliding, those currencies can lag weaker. If it's just a one-day premium move, FX may barely react. Bucket 3 is credit and equities. Energy equities and high-yield energy bonds can react with a short lag. If spreads stay calm, the oil move is contained. If spreads widen, it becomes a broader risk signal. Back to our airline fuel manager. In the next 24 to 72 hours, they face a simple problem. Do you lock in this lower price, or do you wait, because the drop could reverse? They are not making an investment call. They are managing operational risk. And the driver is the same. Is the premium gone for good, or just for the weekend? So, what would change that answer? You need receipts, not vibes. Receipt 1 is the OPEC Plus decision itself. Output unchanged for March sets the baseline. That tells you the group is not flooding the market. Receipt 2 is the price tape with exact prints. Brent around $67. WTI around $63. That's your shock size. Receipt 3 is the calendar. OPEC Plus meets again on March 1. That's the next policy catalyst. Between now and then, the market lives on headlines and data. Now the stakes ladder starts. Near term, the pressure point is headline velocity. If talk headlines reverse, premium can snap back. You'd see that in a 1 or 2 session rally. Over the next 2 to 6 weeks, the pressure point becomes physical confirmation. Do inventories build? Do refinery margins weaken? Do time spreads keep flattening? If this persists into spring, the break shows up in inflation and growth narratives. Oil stops being an inflation accelerant. It becomes a growth barometer. That can change how rates and equities trade together. Now, lock in the three signals. Exactly three. Concrete, trackable. Signal 1 is the Brent prompt spread. Look at the front month versus 3-month spread on ICE. If it tightens back into backwardation, tightness is real. If it keeps flattening, the market sees enough supply. This often shifts within 24 to 72 hours. Signal 2 is energy equities versus crude. Watch a simple ratio like the energy sector versus the S&P 500. If oil drops but energy stocks hold up, the market sees a temporary premium story. If both slide together for several sessions, sentiment is turning. This usually lags by 1 to 3 days. Signal 3 is inflation breakevens. Watch 5-year breakevens in the U.S. market. If breakevens drift lower after oil falls, inflation fear is easing. If breakevens ignore the move, oil is treated as noise. This tends to lag by 2 to 5 sessions. One reasonable read is this was premium compression. OPEC Plus held output steady, but the market priced lower disruption odds. That can fade fast. Another read is demand is soft and premium was the only support. That would show up in inventories and spreads. Either way, the next week matters because this story is measurable, not emotional. Here's the deeper question. If OPEC Plus did not add barrels, why did buyers step away? Because the market does not price policy. It prices the marginal barrel today. And the marginal barrel is priced through expectations. So you have to separate three things: supply policy, physical flows, and probability of disruption. OPEC Plus policy is the easiest headline, but it is not the fastest price driver. On a fast tape, probability wins. And probability is basically a forecast of friction: sanctions friction, shipping friction, insurance friction, payment friction. A single talk headline can change friction expectations. That can move the premium. And premium is what gets compressed first. There is a simple receipt you can show. Take the Reuters print with the exact move. Brent near 67.39, WTI near 63.32. Then put it beside the line, March unchanged. That is the mismatch in one frame. The second receipt is the OPEC statement itself. It anchors the baseline. It tells you March policy is not looser. When policy is stable and price falls, you ask this: did demand weaken, or did risk premium unwind? The best way to answer is the curve, not the spot price. If risk premium is unwinding, the front end softens first. Time spreads flatten. Volatility can drop after the initial shock. If demand is weakening, the curve can also flatten. But you usually see other confirmation. Refining margins ease. Cracks soften. Physical differentials weaken. So the curve is necessary, not sufficient. Think about our airline fuel manager again. They do not hedge on headlines. They hedge on budget certainty. A 3% oil drop helps their next invoice, but it also changes their worst-case scenario. If premium is compressing, the worst case is a snapback. If demand is weakening, the worst case is missed savings. Those are different risks. And the hedge decision flips with the driver. That's the 24 to 72-hour stakes. Not will oil go up, but will volatility return? Because volatility costs money, even if price falls. Now, step into the 2 to 6 week window. This is where the receipts stack up. First, look at inventories. Weekly changes are noisy, but trends are real. If stocks build for several weeks, demand is soft. If stocks draw, tightness is real. Second, look at OPEC Plus discipline signals. Compliance matters more than declarations. If production leaks higher, the freeze is cosmetic. If compliance holds, the floor strengthens. Third, watch physical market tells. If physical differentials weaken, reality is easing. If they hold firm, paper selling may fade. This is where the story becomes cross-asset. Because crude is not just energy. Crude is inflation expectations and risk appetite. If oil keeps sliding, inflation pressure eases. That can pull down near-term breakevens. That can relieve some rate pressure. It can also reshape equity leadership. Higher oil hits consumers and margins. Lower oil can help real incomes, but it can also signal weaker demand. So, the direction alone is not enough. You need the reason. If it is premium compression, it is a volatility story. If it is demand weakness, it is a growth story. Markets react differently to those two regimes. In premium compression, risk assets can stabilize fast. In demand weakness, credit gets nervous. That is why credit is the confirmation layer. Watch high-yield energy spreads. Watch investment-grade energy spreads. If spreads stay calm, it is mostly contained. If spreads widen, it is stress. Now, the what breaks first angle. If this worsens, the break shows up here. Oil time spreads keep flattening. Energy equities underperform for multiple sessions. Break-evens drift lower with follow-through. That trio would tell you the tape is shifting. The next big catalyst is not a meeting. It is data and headlines. Because OPEC Plus is already set for March. The market is trading expectations until March 1. So your next 7-day catalyst stack is simple. Any credible change in disruption probability. Any credible change in physical flow constraints. Any surprising inventory trend. That is the 7-day stakes, not the level of oil. The stability of the narrative. Back to the airline fuel manager. Over the next 2 to 6 weeks, they face a second consequence. Jet fuel prices follow crude, but not perfectly. If refiners see weaker demand, cracks can compress. That can lower jet fuel faster than crude. If supply is tight, cracks can stay wide. That can keep jet fuel elevated even if crude fades. So they watch refining margins too. They do not need a prediction. They need a signal. If this persists into spring, the stakes shift again. Oil becomes a macro barometer. Lower oil can pull inflation fear down. That can change the Fed debate at the margin. But if lower oil is demand-driven, growth worries rise. That can lift credit risk premia. This is where viewers get fooled. They see lower gas and think good. Markets can see lower oil and think slowdown. Both can be true, depending on the driver. So keep it grounded. You track the same 3 signals, the curve, the equity confirmation, the inflation pricing response, and you keep one question constant. Did the probability engine move, or did the fundamentals engine move? Now tie it off with a clean recap. What happened was simple. OPEC Plus kept March output unchanged. Oil fell nearly 3% anyway. The verified receipts are clear. Reuters printed the move with the exact prices. Brent about 67.39, down about 2.8%. WTI about 63.32, down about 2.9%. And Reuters reported OPEC Plus agreed to hold output steady. OPEC's statement reaffirmed a pause by 8 participants. The mechanism is also clear. Oil trades on 2 engines, slow fundamentals and fast risk premium. A stable supply policy can still coincide with a premium unwind. If disruption odds get repriced lower, the insurance embedded in crude drops. That can pull prices down even if supply is not getting looser. Why it matters is not the headline. It's what the move is telling you. Premium compression is a volatility story. Demand weakness is a growth story. They trade differently across rates, FX, credit, and equities. The stakes ladder is the part people skip. In the next 24 to 72 hours, the risk is a snapback. Talk headlines can reverse. Premium can return quickly. You see it first in the front end of the curve. Over the next 2 to 6 weeks, the story gets judged by physical receipts, inventories, time spreads, physical differentials, and refining margins. If those soften, the demand story wins. If they stay tight, the sell-off was mostly premium. If this persists into spring, oil stops being an inflation accelerant. It becomes a macro barometer. Lower oil can ease inflation pressure. But if it is demand-driven, credit becomes the stress test. Bring back the anchor one last time. For that airline fuel manager, this is not a price prediction. It's a volatility decision. They decide whether to lock in a lower invoice or wait because the tape can reverse. And the driver determines which risk they are managing. Now, the exact 3 signals to watch. Signal 1 is the Brent prompt spread, front month versus 3 month. If backwardation rebuilds quickly, tightness is real. If it keeps flattening, the market sees comfort on supply or demand is softer. This shifts within 24 to 72 hours. Signal 2 is energy equities versus crude. Watch energy relative strength against the S&P 500. If oil drops and stocks hold, premium is probably the driver. If both slide together for several sessions, sentiment is turning. This usually lags by 1 to 3 days. Signal 3 is inflation breakevens. Watch 5-year breakevens. If they drift lower after this move, inflation fear is easing. If they ignore it, the market is treating oil as noise. This tends to lag by 2 to 5 sessions. That's the risk, and that's the recap. If you want the clean signal check, look at those 3 markers this week. I'll see you in the next one.